January 2, 2009. The Real Estate Capital Scoreboard. January 2009. Chicago, Illinois, January 2, 2009. The last month of the year ended on a dramatic note as the Fed forced key short-term indices into record low territory. Meanwhile, the ongoing shortage of real estate capital dampens any meaningful mortgage rate reductions. Important market highlights and trends for 2009 are as follows. Funds resurfacing. Select life companies are cautiously returning, one of the bright spots in an otherwise bleak market. These institutions are primarily targeting highly conservative opportunities and lower leverage acquisitions. Refinancing reigns. Since the market remains illiquid with sellers and buyers quite far apart on bid-ask sale negotiations, refinancing is the only option for generating significant loan volume. For example, borrowers with 5- and 10-year loans due this year should expect to see rates at about identical levels to the marketplace on 10-year maturities as compared to 1999. 5-year maturities are about 150 basis points higher than in 2004. Absolute rates. Due to benchmark rate volatility, most lenders avoid pricing mortgage rates over spreads and instead offer absolute rates. Volatile indices. Overall mortgage rates drifted slightly upwards for shorter-term fixed-rate maturities, 5 years, as lenders demand a premium for locking into this highly desirable term. In contrast, longer-term benchmark rates dropped by about 20 to 50 basis points, while lenders react cautiously to any corresponding mortgage rate drops. Steep yield curve. The Treasury curve remains steep with short-term yields approaching zero, indicating an extreme desire for safety void of any principal repayment risk. Shorter-term indices dramatically plunged by about 75 basis points or more, particularly LIBOR, which dropped by nearly 150 basis points. Dominant players, the agencies, FNMA and Freddie Mac, overwhelmingly dominate the multifamily lending arena, which is the most active property funding sector. The agencies offer below rates starting below 6% for shorter-term maturities and below 5% for floating-rate debt. Life insurance companies and banks dominate all other income property sectors with rates relatively unchanged from the previous month, hovering in the 6% plus range for 5-year term and 7% or more for longer-term loans. According to Nat Svislow, research director of the Real Estate Capital Institute, 2009 looks to be a year of refinancing and with limited acquisition activity. Adding, distressed deals will be the norm for most new acquisitions and lenders will be overwhelmed with renegotiating over-leveraged debt.
February 2, 2009. The Real Estate Capital Scoreboard. February 2009. Chicago, Illinois, February 2, 2009. The realty capital markets remain disruptive, raising stress levels for borrowers with pending maturities. Meanwhile, sellers are unable to generate liquidity as pricing volatility prevails. Smaller transactions are more fluid with recourse requirements much more common as borrowers weigh their options using shorter-term debt. Industry leaders expect minimal positive changes in short-term market dynamics as the financial sector digests unsettling news. Starting this year, evolving trends are as follows. Minimum yield requirements, not spreads over benchmark indices, dictate loan pricing. Mortgage rates are somewhat stable, as lenders set floors on long-term fixed-rate debt in the 6.25 to 7.5% plus range for most conventional properties. While rates are within historically favorable limits, continued tightening of other key underwriting parameters restricts meaningful funding volume. More constraints that are conservative include lower valuations, limited leverage, shorter amortization payment schedules, higher debt coverage and substantial escrow/reserve requirements. On the public market debt front, CMBS is unlikely to return in the foreseeable future, at least not in the current format. Balance sheet lenders also struggle with the denominator effect, limiting overall funds available for real estate investment, as portfolios are devalued. Furthermore, real estate investments must compete with attractively priced stocks and bonds as astute fund managers hunt among abundant bargains. Mezzanine and opportunity funds offer capital, but underwriting is cautious and existing note sales compete for these funds. Pricing on mezz debt starts in the lower teens. Transaction volume flirts with the lowest levels in decades as capital sources wait on the sidelines in hopes of finding the bottom. Substantial pricing discounts are expected throughout 2009, in any case. Equity returns are under upward pressure. Overall equity yields for Class A core institutional properties trade from the low to middle teens, core plus assets trade within the upper teen range, and opportunistic ventures offer returns in excess of 20%. Given illiquidity within the equity markets with few comparable trades, numerous lenders are setting valuation parameters for debt fundings. In general, the 8% to 9% capitalization rate range is a popular appraisal benchmark for higher quality commercial properties in most markets throughout the country. Multifamily properties start at 7% cap rates, although limited trading volume prevents identifying clear and reliable pricing trends. Jim Postweiler, advisory board member of the Real Estate Capital Institute, suggests buyers and sellers are reluctant to transact due to stingy debt markets. However, signs of improvement are emerging as buyers realize few opportunities for core properties are available.
March 2, 2009 The Real Estate Capital Scoreboard - March 2009. Chicago, Illinois, March 2, 2009. As the first quarter winds down, the real estate capital markets are filled with caution and anxiety as lenders crave for market stability. Realty capital markets remain challenged with the following issues in the forefront of discussion. Valuation concerns. Many investors believe that cap rates will return to higher single digits, in norm with historical levels. Institutional-grade assets are valued starting at 7% for multifamily properties and 8% for commercial properties. Furthermore, lenders require substantial supporting data, recent comps, to justify lower cap rates. Secondary markets and older properties pricing start at 100 basis points or more with much wider variance. Capital availability/allocation. Most financial institutions are playing a defensive role, rather than pursuing aggressive growth and funding strategies. Shoring up balance sheets and shedding unwanted loans and other realty assets remain key priorities. Select sources state that they would like to return to the market by the second quarter and mid-year. Lenders are allocating substantial portions of funds for refinance and rollover, rather than new loan origination. Relative value pricing. Attractively priced CMBS debt, AAA quality, offers the best investment opportunities for investors preferring to capture the most favorable yields, rather than new origination funds. Such yields are in the lower double-digit range. As such, mortgage rates are still favorably priced for borrowers, within the range of 6.5% to 8.5% for conventional properties based on 10-year terms. Delinquencies. For the most part, loan delinquencies and defaults are at controllable levels. Retail properties pose the most challenges, as numerous merchants are in either bankruptcy or requesting substantial rent discounts. Co-tenancy issues also raising concerns for further occupancy reductions. Tighter funding standards. Most lenders are strictly enforcing shorter amortization schedules and wider debt coverage ratios, for example, 1.25x and 25-year maximum, to restrict proceeds, rather than relying on loan-to-values restrictions as a primary underwriting variable. That said, 55% to 65% is the norm for most institutional quality, non-multifamily loans. Rights. Pension funds and private equity capital players requiring less leverage enjoy excellent rates and terms. Leverage-oriented investors are forced to stay with bank lines, hoping for more favorable funding conditions. Maturity risk. Agencies and many life companies favor longer-term loans in excess of 5 years as refinance rollover risks are of concern. Meanwhile, banks mitigate such risks by relying upon recourse and substantial funding deposits, often in excess of 10% of the loan amount. Large loan vacuum. $50 million plus loan funding sources are limited to about a half dozen major life companies. Otherwise, lenders must syndicate such loans. Loans under $10 million still offer numerous options including banks, life companies and private capital. Floor rates prevail. While lenders are still quoting fixed-rate loans based on treasury spreads, most loans feature floor rate minimums. Naturally, Floating rate loans are still quoted floating over LIBOR, prime, etc. Floors are also imposed on such funding structures. Randall Dawson, a member of the Real Estate Capital Institute Advisory Board, declares, 2009 looks to be a year of refinancing and with limited acquisition activity. Dawson suggests, distressed deals will be the norm for most new acquisitions and investors will be overwhelmed with renegotiating over-leveraged debt.
April 1, 2009. The Real Estate Capital Scoreboard - April 2009. Chicago, Illinois, April 1, 2009. Commercial and residential income property values and mortgage underwriting continues readjusting to more conservative levels not seen in more than a decade. While most buyers and sellers are tangled in a pricing stalemate, funding sources define debt and equity metrics based on refinancing and renegotiating terms. However, such metrics substantially vary from the sizing dynamics that many investors have grown accustomed to. Current underwriting realities mainly include stringent resizing of existing cash flows, higher capitalization rates and lower new construction costs, all summarized as follows. Cash flows readjustments. Best cases assumes annualized with a careful review of recent trailing 3 months occupancy and collections. Reforma versus pro forma, whereby funding sources expect outright lower income in anticipation of more challenging economic conditions. Numerous lenders expect income levels to drop from 3% to 6% during the year. Expense increases. Higher vacancies translate to carrying more common area expenses. Furthermore, few investors expect meaningful lower taxes and operating costs. Higher capitalization rates. 8% is the now new valuation benchmark for most commercial properties. Single tenant, credit deals secured by longer-term leases hover in the 7% range. Below 7% reserved for prime residential and trophy properties or properties with substantial contractual upside. Full-service lodging starts at 9%, a low single-digit range as RevPAR and operating cash flow have been substantially reduced since 2008. Smaller projects based on 1031-X trades may be priced as much as 50 bits per second lower than typical capitalization rates, as demand remains brisk. Substantial widening for C properties by at least 150 basis points or more, moving into the double-digit range. Price reductions of 30% or more are common as compared to credit and Class A/B assets, as this segment of the market remains very illiquid. New construction realities. Despite public infrastructure spending, construction costs are lower as construction spending has decreased and competition has increased. Commercial building construction costs have fallen by more than 10% during the past year. Return on cost yields are in the double-digit range. As investors focus on purchasing projects well below replacement costs and higher leverage debt is scarce, development yields must be priced 200 basis points or more above cost of debt. According to Aaron Grun, a member of the Real Estate Capital Institute Advisory Board, while declining rents, rising capitalization rates, and challenging economic and financial conditions make for black moods for real estate investors and developers, this is a good time to prepare for the return of prosperity. He adds, from a longer-term perspective, prices are more likely to be bargains, construction's costs are low, and loans are likely to be prudently made and taken. May 1, 2009. The Real Estate Capital Scoreboard - May 2009. Chicago, Illinois, May 1, 2009. Within the past month, rates have continually climbed for longer-term treasuries, nudging upward by more than a quarter point. In the meantime, the most active lenders in the marketplace, the agencies, Freddie Mac, Fannie Mae and FHA/HUD, correspondingly dropped mortgage spreads. As a result, overall interest rates remain relatively competitive for multifamily properties, starting in the mid-5% range for 10-year debt. Leverage levels of 75% of value are still available for this asset class. In contrast, other income properties, including office, retail and industrial assets, are underwritten to extremely stingy standards. Few lenders are actively seeking new origination funding opportunities as workouts and corporate viability issues overshadow mortgage lending goals. Commercial loans are generally funded at levels of 65% or less, with overall interest rates starting in the higher 6% range and climbing into the mid-8% range. Full leverage funding opportunities still exist for credit-anchored projects in all income property categories, as long as BBB or better-rated credit ratings are available with reasonable remaining lease terms. Bright spots in the capital funding marketplace are also beginning to appear. More life companies, banks, pension funds and other sources not plagued with legacy deals are re-emerging. Initially, the pricing requirements are steep and leverage remains conservative, but some loosening is expected as these players start competing for transactions. As far as specific benchmarks for any funding opportunities within today's market, the following items are nearly universal minimum requirements. Lower values. Property values continue declining as more investors realize operating losses and lenders foreclose on distressed assets. Limited growth. Few, if any, markets are underwritten with any type of income growth. On the contrary, most lenders are forecasting flat or declining income conditions with expenses rising. Higher coverage. 125% debt service coverage ratio for nearly all properties is a minimum threshold. Greater equity. For refinancings, borrowers must show at least 20% or more of real equity, as cash-outs are frowned upon. More reserves. Effective property age concerns are forcing borrowers to set up larger reserves for maintaining and retaining competitiveness. Barry Moss, a Real Estate Capital Institute Advisory Board member, notes lenders, borrowers, investors, tenants, developers and nearly everyone in the real estate industry is in a defensive mode. He suggests, as TARP/TALP funds trickle into the financial system and lenders mark down legacy assets to current metrics and sell those assets, more badly needed liquidity will return to the industry and transaction activity will increase.
June 1, 2006. The Real Estate Capital Scoreboard. June 2006. With the exception of LIBOR, which climbed nearly 10 basis points, rates are nearly identical to last month. Throughout May, rates fluctuated by about 10 basis points. Although interest rates are rising, property capitalization rates are slow to follow. High-quality income properties are in short supply. Numerous buyers will purchase new construction, as property sales prices approach reproduction costs. Even with negative mortgage news about agency accounting issues and rising loan defaults, mortgage spreads still remain very attractive. Experts predict widening spreads as more such news filters into the realty capital markets. July 1, 2009. The Real Estate Capital Scoreboard. July 2009. Chicago, Illinois, July 1, 2009. While the Fed decides to keep interest rates steady, the capital markets reset property values and debt underwriting metrics to levels not seen in nearly a decade. Meanwhile, lenders focus on recasting legacy deals with preferred borrowing relationships. As expected, new funding opportunities are extremely limited based on highly conservative leverage of 60% or less for commercial properties with capitalization rates in the high single-digit range. On the other hand, apartment financing funds remain readily available via the agencies at attractive spreads and leverage. However, more submarkets are reviewed for possible downgrades as vacancies continue to rise throughout various parts of the country. While the market activities are generally slow, especially in the midsummer months, clear signs of readjusting capital markets are evident as noted by the following dynamics. As capitalization rates approach 10% for many type of core plus investments, pricing on a per-unit basis look right according to many investors, yet uncertainty remains with respect to rent growth and tenant retention. The big fear being reduced cash flow pro forma projections, now known as re forma. Landlord underwriting is now an important part of the tenant process to ensure performance on space build-out, payment of commissions and reliable future operations. Landlords without the ability to demonstrate capital resources are at a competitive disadvantage. Zombie properties, defined as overvalued performing assets which will be difficult to refinance within the immediate and medium-term timeline, haunt lenders and borrowers alike as to exit strategy reversions. Net operating income calculations based on adding capital reserves create more debate between buyers and lenders. Lender funding availability and underwriting guidelines overrule any such discussions. Active bidders include private funds in various formats such as REITs, opportunistic syndicates and wealthy individuals, few public players hunting today. Largest transactions are limited to about $75 million per lender, and few deals are clubbed as lenders remain focused on internal portfolio issues. An advisory board member of the Real Estate Capital Institute, Jim Postweiler, notes that smaller properties below $25 million enjoy the most amount of acquisition activity. Larger projects still create issues for attracting optimum leverage and sufficient funding sources. Postweiler adds, foreign investors, mainly from Europe, are re-emerging as buyers for prime investments in major CBD markets. August 3, 2009 The Real Estate Capital Scoreboard August 2009. Chicago, Illinois, August 3, 2009, Midsummer market madness clouds the real estate capital industry, yet bursts of hope glimmer as more properties are sold and investors are beginning to see a bottom. As short-term rates remain near the bottom, with LIBOR sinking to a record low, plenty of funds are available. However, funds are sidelined in anticipation of even more favorable pricing in the coming months as distressed deals are predicted to flood the market within the next 2 years. Other market highlights include the following. Pricing readjustments of 20% to 30% below 2007-08 levels emerge as new benchmarks. With rare exception, pro forma valuation is replaced with direct capitalization of actual income. In fact, most investors are revamping net operating income figures with downward income expectations, while expenses are expected to rise, particularly property taxes and utilities. The yield curves for secondary market and older properties are substantially steeper as investors focus on prime location assets at relatively attractive price levels. Such assets are sized based on overall yields often in excess of 15% or more. Mortgage pricing substantially favors multifamily assets as debt is still available at 6% or less for higher leveraged the assets via the agencies. Conversely, commercial properties are financed at levels of 60% of value or less with strict cash-out requirements and other provisions, for example, recourse, previously thought too onerous as lenders cherry-pick deals. With distressed debt deals offering very appealing rates and principal reduction, astute investors redouble efforts in this investment arena. Loan-to-own opportunities appeal to such buyers, especially those with development and management expertise. Banks and other distressed financial institutions provide an ongoing pipeline of deals. Hidden prepayments plague many acquisition deals with existing, assumable debt as lenders force pay down, along with corresponding penalties, in those cases where the purchase prices create unusually high leverage due to the denominator effect. Less evident, although just as critical, the same issue applies for lenders requiring pay downs from borrowers, even if no new recapitalization occurs as balance sheet cleansing continues. Gary Duff, an advisory board member of the Real Estate Capital Institute, remarks that more market clarity is expected in the fall when investors return from the summer holidays. For now, Most institutions consider asset management as their top priority. He suggests, many legacy owners are more concerned about losing income stream rather than capturing new opportunity plays. September 1, 2009 The Real Estate Capital Scoreboard September 2009. Chicago, Illinois, September 1, 2009, declining property values prices reset investment yield boundaries for all types of income-producing properties. No asset classes are immune, ranging the entire spectrum from institutional quality, credit net lease deals to distress hotel ventures. With limited exceptions, new construction developments grind to a halt as investors rethink risk/reward because of ever-eroding market fundamentals. The DeFi refi takes front stage among lenders with legacy loans, whereby debt terms are defensively renegotiated. All parties try to avoid foreclosures as long as the collateral is reasonably maintained at occupancy levels within the given submarket. DeFi refi loan sizing is further outlined as follows. Other than senior housing in select markets, few properties see any rental growth. Protecting existing cash flow remains a top priority in contrast to any increases. Pro forma projections are reviewed downward, as owners expect stable or declining rents/occupancies. For instance, multifamily properties with rental decreases of 3% or more are underwritten and trended downward versus trailing operating history figures. Markets are strained with a special emphasis providing some form of debt relief in key markets, for example, Florida, the Inland Empire, Phoenix, Austin, Las Vegas, Atlanta, the Upper Midwest. Voluntary conversion of debt to partial equity is offered as an additional solution to eroding debt balances, increasing 2% or more on vacancy rates for apartments. Roll-in of the prepayment penalty deemed to be a cash-out, defined as an optional cost to better their financing, hardlined by FNMA-small penalty, for example, 2%, not a big issue if a couple of 2% on LTV but not 75% to 80% jump, for instance. Standard provisions include lengthening amortization schedules and loan term, offering interest-only payments, reducing, or removing, non-monetary default provisions such as debt service coverage and loan-to-value covenants and partial forgiveness of debt. The Real Estate Capital Institute's advisory board member, Harold Skip Harry, laments, "The volume of foreclosures and restructuring leads me to believe the end is not in sight for at least 1 to perhaps 2 years." Skip suggests, defensive investment tactics are the norm rather than the exception until more trades occur and properties are marked to market based on current conditions.
October 1, 2009 The Real Estate Capital Scoreboard October 2009. Chicago, Illinois, October 1, 2009, the Fed announced that the recession is starting to fade away. The real estate capital markets remain in the doldrums, with more news of increasing delinquencies and foreclosures, looming loan maturities with limited refinancing prospects, declining occupancies, tenant bankruptcies, oversupply and contracting space demand well into the foreseeable future. Yet fresh transactions are trickling into the markets, filling valued data points. As financial markets are recovering and lenders shore up their balance sheets, deals are repriced, sometimes at levels of 20% to 40% lower than the peak era of 2006-07. This fall's positive signs shining on the capital markets include the following. Substantial amounts of capital funds are flowing into the public markets, mainly into mortgage and equity rights. However, finding qualified investments at distressed pricing remains the biggest challenge. Life companies trickling back into the mortgage market, as overall bond pricing has improved. As a result, pricing is tightening by at least 25 basis points. However, Many life companies still feel minimal pressure to originate new loans, continuing to adhere to minimum loan floor rates. For high-quality assets with conservative leverage, no cash-out rules are relaxed as funding sources vie for the premium properties. As equity positions vanish in newer legacy ventures, mezzanine and other subordinate lenders busily work to maximize their ownership positions, hoping to protect their investments as markets gradually recover. In many instances, some of the same lenders converting into ownership positions as also raising additional funds for buying other properties to profit from the currently distressed environment. Randall Dawson, a member of the Real Estate Capital Institute's research notes, valuation driven by lower leverage debt pricing and higher equity yields offers the most effective methodology for understanding values in today's illiquid markets. Adding, equity yields continue climbing, as commercial property values show more signs of stress. November 2, 2009 The Real Estate Capital Scoreboard - November 2009. Chicago, Illinois, November 2, 2009. The recovering stock market is gradually translating to more favorable conditions in the realty capital markets. While the capital markets are relatively dormant as lenders seek to shore up the balance sheets, select life companies, banks and private funding sources continue conservatively funding transactions. Furthermore, mortgage rates have re-entered the market, seeking higher leverage loans, but at larger rate premiums. Greater competition from this sector will continue pressuring other lenders to offer better pricing. Regardless of pricing, project quality and sponsorship remain tantamount as lenders stay defensive. As such, current pricing trends include the following. During the past month, benchmark treasury yields moved nearly 0.25% higher, yet rates remained steady as many lenders continue using rate floors for permanent loans. Floating rate debt remained unchanged as prime bank customers pay floating rate pricing starting at about 4.5%. While new transactions are still rare, refinancings and restructuring of loans remains in the forefront of real estate capital markets. Appraisers and investors are using band of investment calculations for sizing values and loans absent of any relevant market comparable data. Given current debt pricing, capitalization rates under such models typically start at 7% for multifamily properties and 8.5% for commercial assets. Multifamily agency pricing favors securitized loans versus balance sheet debt as the agency's CMBS markets slowly recover. Opportunity investors armed with significant equity capital aggressively hunt for bargain-priced distressed assets with pricing of 20% or more on an overall return basis using 5 years or less time horizon. Commercial and industrial tenants with specialized space needs and multifamily projects using FHA funds, such as 221d-4, are the only sources of new construction demand. Return on cost yields start at 8% for definable creditworthy tenants, otherwise double-digit figures are more representative of current development risk pricing. Aaron Grun, an advisory board member of the Real Estate Capital Institute notes, the Great Recession has permanently altered consumer, investment, and governmental behavior. Both public and private sector interests which influence land use and economic development need to reset their models and practices to work out projects and plans affected by the Great Recession and to respond to the opportunities the economic recovery will present. December 1, 2009 The Real Estate Capital Scoreboard - December 2009. Chicago, Illinois, December 1, 2009. Substantially discounted senior loan levels combined with eroding property values force legacy funding sources into difficult decisions in managing technical defaults, monetary defaults and loan maturities. The stage is clearly set for workouts and recapitalizations well into next year, while new lenders are seeking high-yield opportunities with fresh capital for workouts/restructures, partner buyouts, loan purchases and property acquisitions. Multifamily and senior housing properties continue attracting low-priced/high-leverage funds via the Triple Fs, FNMA, Freddie and FHA. Otherwise, commercial properties attract capital with mixed results. For instance, partially leased, Class B office ventures are considered only if located in Class A locations. Discounted cash flow underwriting for such fundings include trended economic vacancy is trended towards historical norms, often below actual figures as investors brace for more economic storms. In today's tight credit market, important metrics for any financing ventures include quality sponsorship. Sponsor analysis is tantamount. Lender must have complete information about a borrower's portfolio performance and maturity schedule. Full understanding required of assets, liquidity, liabilities including all contingent liabilities. All information must be up to date, especially valuations and economic performance. Reset valuations. Commercial real estate prices have dramatically declined by more than 30% from a year ago and well over 40% as compared to peak levels of 2007. The most shocking is the steep plunge in prices for multifamily assets, historically considered the most immune sector in the industry. Furthermore, even the most resilient markets in the country, for example, Northern California, report fundamental weakness in demand. Changing credits. Although numerous credit tenants are contracting, newly forming tenants emerge including governmental agencies, academic institutions, specialty retailers, etc. Additional leverage, mezzanine loans and preferred equity selectively offered for building up the capital stack. Consideration of additional collateral and partnership interests for leverage enhancement. In summary, overall market sentiment focuses on avoiding liquefying legacy projects unless absolutely mandatory. Mark Hayden, an advisory board member of the Real Estate Capital Institute notes, credit tenant commercial properties remain financeable, although strict underwriting standards are necessary.